guys, I hope we are all okay. Today's session is a continuation of what we started. So in our class today, I want us to concentrate on a question that was tested in December 2022 sitting. This is CAS NEB exams, and the concept was all about net present value, extended net present value, commonly known as XNPV. We are also supposed to handle XIRR, which is extended internal rate of return, as well as IRR. These are very interesting concepts that if at all you're having the knowledge on the same, you'll always find it to be very, very interesting applying this concept also in practice. And as I've always said, that this is not only for exams, right? But it is for knowledge. So let us jump to that question and see what you are asked and how you're supposed to handle it. Yeah, this was the question. So this is a question that basically was asked in December 2022 sitting. Ideally, these were the whole questions from question 21 to question 25. These were multiple. At least you're supposed to select either of the three questions, right? So this document, actually, you can just get it below this video. I'll attach this Excel workbook just below this video. This is a setup of how they normally tend to set the exams, whereby you're supposed to insert your registration number basically, and you're going to work it out practically. So in this question of ours, concept of net present value, and before we jump to this question, just a brief reminder on what we've been doing on NPV. We must understand first of all what NPV is, and basically these are what we talked about NPV, right? Recall and share this document because already we also talked about XNPV in our classes. So you'll find that anytime you have to look at, anytime you hear about NPV, what you should be able to understand is that at this point we are looking at the difference between the present value of cash inflow and present value of cash outflows. That is the initial outlay. That is the initial outlay. And at this point, you'll find that these cash flows basically are going to be discounted using the firm's cost of capital, which in other words, we normally refer to it as what? WACC. My good students, it is very important to understand that at any given point in time, whenever we are looking at NPV, ideally this time we can term it as ordinary NPV. Term it as ordinary NPV. It is only an assumption that these payments which are made in future, they'll always be made on regular basis with equal time intervals. That is to say, whenever you're talking of with equal time intervals, say for example, if you're receiving you're receiving these payments, say like in January 2021, say like January 2021, we can have it in the same maybe value. You can have it say like in Feb 2021, March 2021, basically after every month, right, on a monthly basis. Also, it can also be in terms of the period, that is to say in terms of per annum. That is, say maybe the first amount maybe you received on December, say 2022. The next amount you're going to receive it in December 2023, December 2024, right? And so on and so on. So you'll find that basically at this point you're looking at what? Equal time intervals. Yes, they are being made on a regular basis with equal time intervals. A time interval of 1 month, 1 month. A time interval of 1 year, 1 year, 1 year. So it is with equal time intervals. But when we are talking of XNPV, my good students, the difference will come in place whereby you'll find that for XNPV, at this point, the payments are made in future, but they are not on equal time intervals. They are not in equal time intervals. That's say that at this point, basically, you are talking of NPV being a modified net present value, or also you can also term it as what? As extended net present value. So you'll find that in this context, XNPV assumes that the payments are not made on regular basis. That is to say, for example, using the previous what we've just looked at here, assuming if my payment is made, say, in January 2021, probably I'm going to receive the next payment, say, like in April 2021. The next payment maybe I'm going to receive, say like in November 2021. The next payment maybe I'm going to receive, say like in March, say like 2022. You see, like basically we are talking of purely irregular basis. These payments are not on regular basis and are also not on equal time intervals. So that is where the concept of NPV normally tend to come in place, because the normal NPV, more so using the functions in Excel, can't solve that, can't solve that, can't solve that. And basically, this is the difference between XNPV and NPV. So to jump straight to our question here, let us see what we were asked to do in this question of ours, which was attested in CASNEB, question number 23, December 2022. These are what you are asked, my good students. We were told in question 23 that you are evaluating a 4-year project with an initial investment of 10 million on 1st January 2023, and the following cash flows characteristics. So these are what I'm given as our cash flow characteristics. I'm having, of course, our period, and we do have our cash flow. This is initial outlay. That's why you're having a negative, right? So basically, this is the data that you are given here. Then the discount rate is given as 8%. Our good examiner here has given us a discount of 8%. We are required, number one, to calculate NPV and XNPV of the project, and hence determine whether the project is viable. A good examiner is giving us what? 6 marks. Surely this examiner wants us to pass this paper with flying colors, right? Then on the other hand, here we are asked to highlight the cause of the differences between NPV and XNPV, and you're also supposed to explain one you will use in your analysis and why. 4 marks. Good examiner. Part B, calculate the IRR and XIRR of the project and hence determine whether the project is viable. Highlight the cause of the difference between IRR and XIRR. So that is what you are asked. So I can zoom in so that it can be very visible. So this is the data that I was given. So first thing first, here I'll be having our solution to this data of ours. Yeah, so basically let me start with, I'm going to freeze this so that you can have it all through. So basically we start with what you are given. Number one, we need to work out NPV. We need to work out NPV and XNPV, right? So I'm going to pick this data of mine. Remember the shortcuts for NPV or function for NPV. In this case, very confidently, I'm going to have our solution here. Can talk of, first of all, we can paste it. So we paste it here. What is happening here? So that is to say, I'm just going to paste it here, right? So once we have it there, that is the data that I have. Now, at this point, it is very important for us to note the time duration. So we want to start with NPV. NPV will be simple. If at all you can replace this by our date factor, maybe you can take yeah, let us go to our date format and see what we'll be having. I custom, of course, I come to my date function here would be, so month, day, year, right? These are date function as per my Excel. Remember, yours can be different. Yours can be different. So therefore, I'm going to start with month here very quickly. I'll be having, of course, month. So 01, talk about 01, 2023. I'll be having, that is June is 6th. That is 30th, 2023, right? I'll be having, in this case, I need to have them on date function, correct? I'm going to have, that is July, that is 07, 31st, 2024. I'm having 30th September, so 09, 30th, 2025. Then I'm having December 31st, 2026. So this is the data that we are having given our period. So basically what I can do, I can have my debt factor there, that is our debt. Then our cash flows, in this case, of course, I can just have my cash flows here, or we can just copy the way it is. Then we do have the normal bit. So this I know it is for that. This I know it is for that. That point there, I'm going to carry this one here. I can have them in value just to make my work neat. So basically these are the cash flows, right? These are the cash flows that you're having. Now, my good students, to sort this one out, the first thing that you need to do is to have our NPV. So that is 1, 2, 3, 4, 5. So what we need to do first, of course, is to work out NPV. And remember the function of NPV, it will always count like this period 1, 2, 3, 4, 5, all the same, right? So I'm going to have our function. Recall, this class we've done it severally in our classes. Ideally here it's just a matter of us doing this question because I'd given you the whole concept of NPV in our previous class. So just be having equal sign, NPV, tab, my rate, we are given what rate. We go back to our question actually. We see the rate that I was given. We are told that the discount rate is 8%. So I'm having here, I can have my rate to be 8%. This is our rate to be 8%. Discount rate is 8%. So I'll be having my discount rate. So what you're going to do, my good students, you're going to do equal sign, NPV, tab, my rate is 8%, comma. In this case, what you need to take is our cash flows, excluding our cash flows, excluding our initial outlay, or rather our investment. So I'm going to start where our cash flow was. Scroll it all through. Then, of course, in this case, I'm going to close it. Plus our initial investment, because remember this is negative, so ideally it's as if we are doing what? We are deducting our initial investment. Then after that case, we do what? Tab. So equal sign, this should give us our NPV. As simple as that. I'm having our NPV there. That will give us our net present value using Excel, as quick as that. So you can use the other concept of PV. Remember the concept of PV function. You can as well decide to go with PV, whereby, of course, you can have our PV function, where our rate is at. Number of period, ideally, in this case, it should have been, because it is our initial investment, so it will take us, it should take us basically 0. So in this case, you can start with your PV here, so that we have it clearly. Just want to show you something here. PV, our rate is at, number of period, basically in this case, it will be 1. I can take period, number of period, we are starting with 1. Initial, or rather our payment here is that bit. It's 27.50. So it will give me this value, but remember, because it is on a financial perspective, I'll have to have negative. Then the same procedure here. What you can do, you can have here period 0, because initial investment 1, 2, 3, 4, so that you can copy your function clearly. Let me just show you this shortcut of ours. My period 1. Yeah. So that what we can lock, of course, is rate. This one you can lock, right? My rate, we can lock basically our rate, so that it will be same all through, locking our rate. Then I scroll it like that to give us our values there. Then of course that is our PV rate is 8%, which should give us that. No, these are what you're supposed to do. Like sorry, remember, like you're looking at our rate, number of period, which is 1. Our payment in this case, we don't have our payment should be like, in this case, payment ideally should be whatever that you're having, which is 0, right? The payment is 0, because in that case, recall, our payment we don't have, but our future value, these are the future cash flows. These are the future cash flows. You're terming them as future value. So then my aspect of future value is what you're having as these figures here. So after that bit, if we copy paste like that, correct? So as at the end of the day, my total present values, I should be having this. Remember, there are so many ways that you can work it out. My total present value, then our initial outlay. Initial outlay is how much? 10 million, right? This is a cost of investment, 10 million. So that this should give us our NPV. Is that 10 million? So basically this should give us our NPV, which here we should be talking of what? We should be talking of our present value minus initial outlay. Present value minus present value of the cash inflows minus initial outlay. So I'll be taking that minus that to give us 791,273, which you can clearly see that it is exactly the same as if we had used the NPV directly. So this is NPV. You see how simple it is. This is NPV. This is NPV. So we've worked out our NPV. Now, what about our XNPV? XNPV is basically a modified net present value. NPV is basically a modified net present value. It considers cash flows where we are receiving on irregular basis. And remember, that can be a fact in the market. You'll find that many a times these cash flows will not be on regular basis or regular time intervals. This time period will always be irregular. And that's where the function of NPV will come in. And to work it out, this is how you're supposed to have, because this is what you're supposed to do, because you'll realize that these periods are irregular. Right? The period of receiving these cash flows are irregular. So how will you go about it? This will be simple, my good students. You are supposed to do equal sign. Then you start now with XNPV. Excel function will definitely give us at once XNPV. My rate, we are going to take our rate to be 8%. Our value, this time round, we are going to start with year 0. 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 So in this case, we should be having all that. The year of investment, you're going to consider that. Of course, I do comma. You'll find that I'm required to input the dates. So I'll just scroll these dates from year 0. Then I close that. Hula, that should give us our XNPV. So at this point, you can clearly see that there's a difference when you're working out NPV and when you're working out XNPV. So XNPV considers different time period. That is, of course, time interval is irregular. Whereas NPV normally tend regular NPV or normal NPV, we normally tend to look at it as with regular time intervals. Yeah, so this is what you are required to do for you to earn the 6 marks. So basically, we are asked to calculate the NPV and XNPV of the project and hence determine whether the project is viable. So at this point, the question is this project viable or not? At this point, you can advise and say that the project is viable. The project is viable. Why are we saying that this project is viable? The project is viable because we have what? Positive NPV. Because we have a positive NPV and XNPV. That is to say, Future, of course, I'll be making losses. This NPV is greater than 0. And that will indicate that, of course, this project has an ability of making profits in future. And therefore, they should go ahead and invest in the project. So basically, we are done with that bit. Then the other area here, we were asked to highlight the cause of the differences between NPV and XNPV. So number one cause of difference you can clearly see is because of the time factor. So ideally here we are talking of what? Time intervals. Where for NPV it considers what? Regular time intervals. Regular time intervals. For XNPV, it will consider what? XNPV. XNPV, it will consider irregular. It will consider irregular time intervals. It will consider irregular time intervals. Then, other cause of difference also here, we can clearly see it is the fact that while let me show you here. You see, like, when considering the values in computing our case, we consider also values in the function, considers also, does not consider, of course, the year of investment, whereas for XNPV, you noted that our PV, we are considering the year of investment, and as such, of course, it will affect the final results that I'll be having, discounted figures that we will be having as at the end of the day. So these are the two main differences, whereas on our case, we are also asked to do what? To select one, right? Explain which one you will use in your analysis and why. At this point, I'm going to use the regular time, I'm going to use the time intervals. Why? Because in this case, you can clearly see in our analysis, like I'm having this component where the first, after investment, I'm going to receive on 30th June 2023. The next value that you're receiving is, that is of course July 31st, September, and as at the end of the day, I'm receiving again 31st. And from January, you see, there's that duration that you've jumped. Then again, September, there's that duration that we jumped. So clearly, this will give us what? A reason of time intervals. And yeah, that's what you're supposed to do in regard to XNPV and NPV as well. I believe you guys have learned. So in our next session, we're going to handle the other segment, which is IRR and XIRR, extended internal rate of return. Recall that our classes are on. You can always join us at any given point in time, because the packages that you do have, they really assist you guys. So to this point, these are what you're supposed to do and also understand. So Mwalimu has attached the document that we've just done right now below this video, which you can get it below this video. I've attached a certain link below this video. Yeah, so basically that is what we are required to do in that question, my good students. And remember, our classes are on for business data analytics. You can always reach us out on the number indicated just below this video. For those who are preparing for the exams in April, we'll always be here to assist you guys. Business data analytics is a very interesting course that, if at all you give it your all, you'll find that you'll always be able to be able to gain this knowledge, and that will make you a whole different accountant even in your organization. You'll be just on a level of your own, right? So let's take this for practice, and you'll find that BDA is a very enjoyable course, and it is not limited to students who are doing only CPA. This is open to any other student who wish to have a knowledge of data analytics. To this point, guys, thank you so much, and let us meet in our next session where we are going to handle IRR and XIRR regarding that question, because we had already did this in our classwork. Thank you guys. See you then.